Welcome to Taking Stock, Empower's first thoughts on leading financial news. I'm Vanessa Welch. The Consumer Price Index report shows that inflation ticked up again in December, marking the third consecutive month of increases. Marta Norton, Empower's chief investment strategist, is here with me today in our Boston office. Marta, great to see you.
Good to see you.
We know that emotions were running really high leading up to the CPI release. A lot of fears out there that inflation seems to be the dragon that we just can't slay. Do these numbers confirm those fears?
You're right on the fear, Vanessa. The lowest year-over-year number we saw was back in September when we saw a 2.4 print. And since then, we've seen inflation numbers come in higher, suggesting to the Fed, to investors, that taming inflation isn't an easy thing. These numbers actually should help alleviate that. We saw headline inflation come in at the expected 2.9% and core inflation drop a bit, which is the first drop we've seen since July, and it was below expectations as well. So, of course, core inflation is the important inflation number to watch. It strips out volatile food and energy prices and gives people a sense for where inflation is actually headed. I, along with many others, have said that this last mile to the inflation target of 2% is the hardest mile to traverse. And that's certainly what we've seen in recent months. But while I think it's a good thing that the market has gotten less complacent around inflation, you remember last year when the market thought inflation was going to drop like a stone, I think there's been an overreaction function that has now leaned too far in the other direction.
It seems like we're walking a tightrope between complacency and overreaction. You often talk, Marta, about the importance of context when we're analyzing numbers like the CPI report. Can you paint a picture for us of how today's numbers really fit into that broader inflation landscape?
Sure. So I think the larger picture here around inflation is that it rose like a helium balloon and is dropping like a feather. In other words, the ascent has been very fast and the descent very slow. A lot of the explanation behind that slow descent actually relates to shelter. Shelter represents 36% of the index, and it only slowly incorporates real-time rents, which shot higher post-pandemic, but have since come back to a more normal level. I've seen analysis by the Fed that suggests that the CPI shelter calculation won't revert back to kind of expected levels until the second half of the year. So I think this is more a matter of patience than anything else, and patience is just something that the market hasn't demonstrated in recent years.
Yeah, and I think that really puts the pace of change into perspective for us, Marta. Let's look ahead a little bit if we can. What do you think these numbers mean for the Fed decision coming up in 2 weeks?
Yeah, it seems to me like a pause has been in the making for quite some time. December was a very cuspy meeting. January strikes me as a sure thing, given the strong labor numbers that we've seen, which helps alleviate the Fed concern that actually kicked off this cutting cycle. And of course, these inflation numbers, which are modestly better than expected, but still pretty far away from the Fed target.
Yeah, it sounds like the Fed is likely to hold steady for now. Ultimately, Marta, I'm curious where you see rates headed and what does this mean for both the consumer and the investor?
I believe we're facing a slow pace of cuts until we start to see data that shows a more consistent cooling trend. I have not yet come around to the market's view, though, where the market is really pricing in just over a single cut for the course of 2025. I expect we will watch inflation drift slowly lower like a feather, and the labor market, while resilient, won't reaccelerate. And that should allow some space for moderately lower rates. But the sense of rate stimulus, where we're getting massively lower rates, which is fueling the market, which is stimulating the economy, that just doesn't strike me as overly likely. And that's something that we played around quite a bit with in the 2025 outlook. So the market, the economy, my expectation is they're going to have to look elsewhere for stimulants right now.
You've been saying over and over, 2025 is the year that we've returned to normal. Great analysis as always, Marta. Thank you so much. And thank you for joining us. We'll be back in 2 weeks to see what the Fed decides to do with interest rates at its next meeting. Have a great week.